All right, welcome back. This type of business joint venture, like the Pogora joint venture, an example on your slides there, it's sort of advisable in the mining and petroleum sector because of the fact that it involves high pre-production costs. So in basically mining companies and mines, before you sell minerals, before you sell the gold, you have to actually build the infrastructure for the plant or the mining camp, and then the extraction, the smelting, all these things need to be built. So in order for you to make a profit, you have to have the construction cost to construct the facility. As a result, because of the big costs, the joint ventures usually enter into detailed agreement which specifies the respective rights and obligations. So joint venture differs from partnership in several aspects. The main one being that the participants do not carry on business in common. So they don't have a common business there. Rather, each participant contributes funds or other property to an agreed stage of production, the fruits of which is directly to them in the manner and proportion set out in the joint venture agreement. So, for instance, you have the Pogora joint venture or you have the PNG LNG joint venture there. You have the total joint venture here. So, basically, what we'll say that let's say ExxonMobil will say that I'll build the plant, Japan will say that I'll build the pipelines. So all these required costs there for percentage of the company. And then once they make profit, the profit will go according to the percentage as well until they fully recover their construction cost and start to make profits. Joint ventures, they don't require to lodge separate tax return, and they may incorporate sales of cost of production, general income, personal expenses. Sometimes they don't pay taxes for a certain period of time because the high cost of construction as well. So the government might give them tax holidays, so they don't pay costs because they're already paying a huge amount of money in the construction of the project. So this type of arrangements, you'll see that basically when they carry out this type of arrangements, what they do is they sign a joint venture agreement. So for instance, in the PNG LNG project, you have joint venture between ExxonMobil, Santos, the PNG government, Nippon. So they own all the percentage. The PNG government through Kumul Minerals Holding Limited owns a 16.8% share in the sort of joint venture agreement. So if you own 16.8%, in terms of constructing the total cost, you have to pay 16.8% of the cost because you are entitled to 16.8% of the profit every time it turns over a profit. All right, the next point there, it's called type of company, it's called a trust. Okay, a trust can be established by deed empowering a trustee to carry on business. In such circumstances, the trustee owns the assets of the business and runs the business for the benefits of the trustees. It is possible for a trustee to be a company, however, attracting limited liability. So this type of trustees is where people pool resources together and a trust is created and the trust is managed by the trustees. So a classical example in PNG, you will know is NASFund, Number One Super. They are what you call trust funds or trust companies. Basically, they hold assets in trust of the contributors. So your public servants, you contribute, and then these trustees own the own the properties in according to the trust. So some of the trustees, very very profitable trustees, they're worth over $1 billion, billion kina, I would say. They have assets and they have sort of revenue generating assets, properties everywhere, all around the country. So just a slight sort of disadvantage of a trust structure is that you must strictly adhere to the terms of the trust deed. Now, when a trustee is a company, it must comply with the Constitution documents and the Companies Act. Legislation relating the powers and duties of trustees must be added to. So it's important that as a trustee you comply with all the legal requirements of the law. And basically, in PNG, you would see that the taxation regime does not favor the trust. So like NASFund, when it's declaring dividends, it's paying tax as well. And then when you try to retire and get all your superannuation out after you left work for a long time or stuff like that, you now have to again pay another sort of tax on top of the taxation that you have already sort of placed or paid. So the company has paid a taxation, and once you want to remove your trust money, you will now have to pay a sort of tax again on your trust. That's why a lot of super fund managers and executives have been complaining about that process and that uh, events and everything. All right, incorporate a company. Incorporation. To incorporate the company, the following forms must be filled. So you have to, all these forms are online. You'll find them at the IPA, Investment Promotion Authority website. And then also, you have to have a company constitution. It's a legal document, basically to incorporate a company. All right. Separate legal entity. Must always know that the company is a separate legal entity. In the next slides, I will cover what we mean when we say separate legal entity.